Hey, welcome back. In this video I'm going to be breaking down the second type of entry for the Fibonacci trading strategy. But before we get to the video, check the link in the description for the full course and get 50% off if you use the top link. And if you remember in the last video, we already talked about the strategy and how it's broken down. Just to refresh your memory, the strategy is broken down into three parts. You have the market structure, which is just the general direction of the price, either up or down in a downtrend uptrend. An uptrend will be price forming higher highs and higher lows. Downtrend will be price forming lower highs and lower lows. Just like this. And then we have the entry, which will be going over today, and then the risk management. In the previous video, we said we use the indicators, the MACD indicator and the exponential moving averages for our entries. Now to get rid of those, in this video now, or this part of the course, I'm going to be going over the Fibonacci or the market structure entry, which is an entry using both the market structure and the Fibonacci. Similar to the first video, we're going to use the market structure, which is price going up or down from higher highs, higher lows, lower highs, lower lows. And we're going to use the Fibonacci for our entry again, along with wrong numbers or the psychological numbers. Okay. First, let's just go over. Let's jump straight to examples. I'll make this video short. Let's jump straight to the examples. Okay, let's go over the examples that we used in the first video. And if you remember, right here we talked about price coming down in a downtrend where price came down from the low, came up from the lower high, came down from the lower low, came up again from the lower high, dropped down to form a lower low, came up from a lower high, then dropped down again to form a lower low in a downtrend, just like this. And remember, we did the example right here. Let's go over this example, but this time we're going to be using the second entry, or the second type of entry. And if you remember, since price is going down, the first thing we need to do is, on the daily time frame, we draw up our fib from the beginning of the impulse move all the way down to the end of the impulse move. Then we switch time frames to the 4-hour time frame to look for our entries. And instead of using the indicators or the cross of the exponential moving averages and the MACD line to fall below the 0 point and the MACD tool, in this case now we're going to be using market structure along with fibs, the Fibonacci tool. So at this point right here, price started to retrace. At this very point, after the impulse move, price started to retrace back to form the lower high. Remember, so it started to retrace back. So this is what we do. We look for a change in market structure. That's the very first thing we do. If price is retracing back, we expect price to be forming higher highs since it's on a downtrend. Price retracing back, we expect price to form higher highs and higher lows. And the way in which we get our entry, we wait for price to change structure from going up in an uptrend, right here, to going down in a downtrend. That's what we look for. So as you can see here, price is retracing back. Price came up from the high, dropped down from the low, came up from the higher high, came down from the low, came up again from the higher high, came down again from the higher low, then went up to form the higher high, before coming down again to form a lower high, no, a higher low, sorry, before coming up again to form a higher high, the very last higher high. Let's, okay, so I'll put this in blue since the price is going up. Now I'll put it in red. Okay, and this is, after this is where the change in market structure begin. Because in order for price to change structure, since this is the previous low, the previous higher low, we need price to fall below this point in order for price, or in order for it to change structure. And it happened right here. As you can see, price came down and broke this low. Broke this low right here. Sorry. Okay, as you can see, price came down, broke this low before coming up again, formed in a higher low, no, a lower high, I mean, then dropping down to form a lower low. As you can see right here, this is where the strategy comes in. Once price change over, or it changes structure from an uptrend to a downtrend, after the very first impulse move, breaking structure like this one right here, we draw a fib again. So we leave the fib from before on the daily time frame, we draw another fib on the forward time frame now, from the top of the impulse move all the way down to the bottom of the impulse move, just like this. And now, sorry, draw this over on the top to the bottom, and now, since we already do it, since we already draw the fib, we wait for price to retrace back to one of our levels on the Fibonacci before bouncing off for an entry. Okay, and if we zoom in, we can see the price came up and bounced off of the 0.5 and the 0.382 point on the Fibonacci. So you may be wondering, which one do we choose to enter on, the 0.5 or the 0.3 or the 0.382? Well, to do that, we'll look at what price was doing before, and as you can see, price formed a level of support right here. We have another level of support all the way over here, and we also have another one, or a level of resistance, I mean, all the way up here. So we wait for price to come back to one of these points, either here, here, or here. And in this case, we have a very strong level right here, because price came down, formed something like a double bottom right here. If you can see, price came down, formed a double bottom. So this is a very strong level. So this will be the level that we're looking for price to reverse on. So we get rid of these other ones. As you can see, price came up into this zone, the zone that we just drawn, the very strong support zone, and then bounced off of it. So since we already have this zone here, what we need to do is look for a wrong number inside of this zone, and this zone basically falls between the 0.382 and the 0.5. So we look for is a wrong number or a psychological number within this zone for our entry. We're looking for a selling entry, a short, and if we look good, we can see that we have the 50 level, or the 50 wrong number in this zone, only the 50 wrong number. So we enter on the 50, wait till price comes up to the 50, place a selling limit. Once price is coming up, we place a selling limit on the 50, and when price hit the selling limit, it will activate it for a sell trade, place our stop loss. In this case, we saw stop loss above the 0.618. 0.618 for the fib that we drawn on the 4 hour time frame. So there's a 51 pip stop loss, and our take profit now will be the very first wrong number before we get to the negative 0.272 on the daily Fibonacci, the daily one, not the 4 hour. So let's look for the, so our take profit is all the way to the 20 right here. All the way here. So our take profit now is 229 pips for a 1 to 4.44 risk to reward ratio. As simple as that. Hope you understood what I was teaching. If you didn't, make sure to rewatch the video from the start to the end again. Rewatch it as many times as you want, just to make sure that you grasp the information.